Here is a recap of the information presented during the Zoom meeting on Thursday, and this is explaining the beginning of Chapter 14, which is, from an accounting perspective, how we journalize when customers are either unable to pay us or choose not to pay us. We're looking at our accounts receivable customers. If you remember, accounts receivable is an asset, and therefore our accounts receivable accounts have debit balances. We're going to be crediting accounts receivable, but it's not for good reasons, because we're kind of marking those customers as do not let this customer work with us anymore until they get things figured out because they've been late. Now, the method that we're using to begin with is called aging of accounts receivable, and what that means is based on past history. And this information, by the way, is from Working Together 1 in your workbooks. We've got this breakdown of our accounts receivable account into what's current, what happened, what's 30 days past due, 60 days past due, 90 days past due, and over 90 days past due. And what we've figured out from past history is that usually 2% of our current customers don't pay on time, 4% of our 1 month late, 8% of our 2 months late, 20% of our 3 months late, and 70% of our over 90 days late account receivable end up not paying us at all. And so we're putting together an estimate of what we expect we're not going to be receiving. If you jump ahead in your textbook to page 417, you can read through this information, and it's telling us the aging of accounts receivable for Brett Company. That's who this information is for, as of December 31st. Now, by the way, we do this monthly, so when you see December 31st, you don't think, oh, that's for the whole year. Nope, this is just for the month of December and looking backwards. And the estimated percentages of uncollected account by age groups are given. We're going to use page 13 of a general journal to journalize how we're going to record this information. So step 1 tells us to calculate the estimate of account receivable accounts expense. Okay, so what that means is you're going to take these current broken down accounts receivable amounts by how much they are past due. We're going to say take 16,045 times 18 and get $329.70 of that which is uncollectible. We're going to take 12,049.05 and multiply that times 4%. Get $499.56 for that amount of expected uncollectible account past due. 6,958.18 times 8%, which is $556.65. 4,218.21 times 20%, which is $843.64. Finally, 3,157.10 times 70%, which equals $2,209.97. We're going to add all of that together, and that is $4,439.52. That's how much we expect not to be able to collect of our total account receivable balance of $43,307.72. Now, it tells us, and we would look this up in the general ledger account, we have a new account that we'll be using this chapter called Allowance for Uncollectible Accounts. And it tells us that the current balance in the general ledger account as of December 1st, the beginning of the month, was $236.89. So what we're going to do is we're going to subtract that amount from the total that we expect not to be able to collect, and we get $4,202.63. Once we get that number, what we're going to do is we're going to update our both new accounts that we're using this chapter, allowance for uncollectible accounts expense and allowance for uncollectible accounts. Now, because we have this new expense account, and this once again is figured out in adjusting entries, we would have this worksheet. We would do the math for figuring out the aging of accounts receivable. Because we always list the debit before the credit, we're going to debit this brand new expense account expenses, once again, are always debited when you think about them. On the income statement side, they take away from your owner's equity, from your revenue. So we'll be debiting the expense, and we'll be crediting this new allowance for uncollectible accounts. And that credit acts that impacts our balance sheet because it takes away from all of our asset accounts. So that's step one. We journalize that. And then step two would be, of course, posting it. We're not doing that yet. There isn't any source document for figuring out this aging of accounts receivable or debiting uncollectible expense, crediting uncollectible accounts, because it is an adjusting entry. It assumes, adjusting entries always assume that you're doing something with a worksheet or making an adjustment to your assets or your expenses and revenues. So that's step one. Okay, now step two is where we get a little busier. And we're going to jump ahead now to 14.2 in the working together. But this is how, after we journalize our uncollectible accounts, this is how we're now going to update our account receivable balance, our individual account receivable customer balances, and also, if our customer pays us, which we hope they do, that we will be working with our cash receipts journal. So let's look at the transactions that we see now on page 424, working together 14.2. Tells us to use page 15 of our journal. Got it? We'll record that. And page 24 of a cash receipts journal. We are now working for a company called Olson Company. And we are going to journalize the transactions completed during November and December of the current year. We're going to post the transactions to the account receivable ledger, and we are going to update our cash receipts journal. So it tells us on November 4th that we wrote off Mellon Corporation's past due account as uncollectible for $494, and our source document is a memo. So that memo is going to be recorded here. When we write it off, what happens is we debit the allowance for uncollectible accounts. If we look back at our general journal from the example in the working together, we credited our allowance for uncollectible accounts, but when we write a customer off, we are going to debit the allowance for uncollectible accounts. Okay, we're going to take away from that expected balance. However, what we're going to do next is we're going to credit account receivable, both account receivable and the name of the customer, in this case Mellon Corporation. So notice when we get to posting, you have to put your slash here. We have to post both accounts of receivable and the individual customer, in this case Mellon Corporation. And so we're crediting account receivable. And normally that's a good thing. In this case that's bad, because we're saying, you know what, we're not going to collect those dollars. When we go to post, we're going to look at that next. I know it shows the post reference account numbers here, but what we're going to do is we are going to post to the allowance for uncollectible accounts. This is the brought forward balance. So on the 4th, we're going to post that $494 debit. That's going to make the credit balance for allowance for uncollectible accounts go down. But as I said, in this case, that's bad. Our source document is General Journal G15, and then we update the balance. Now, the next thing we're going to do is we're going to post to account receivable. Once again, General Journal 15, but notice it's a credit. That's going to make our total account receivable balance go down. The credit subtracts from the debit balance. Our new debit balance is $34,654.85. And now we're going to post to our individual customer, which was Mellon Corporation. But notice we're going to put the words written off here. That's bad. That means we're not doing any, allowing that customer to do any business with us. This was once again journal page 15. That credit of $494 makes it look like we have a zero balance, but once again, not good. The second transaction is on November 15. It tells us we wrote off Horn Company's past due account as uncollectible. And it gives us that amount, $1,548, memo 147. This is a similar transaction. So whenever you see the words write off, you know immediately you're going to debit allowance for uncollectible accounts, credit account receivable when you write off. The memo 147, now don't worry that we're skipping memo numbers in the general journal. Memos can be recorded in other journals also. So we've got the $1,548 debit to allowance for uncollectible accounts. We've got the $1,548 credit to both account receivable and Horn Company. We're writing the slash in because when we post these, which we're doing next, we're going to post to allowance for uncollectible accounts and both account receivable and the individual customer's account receivable account. So posting is going to look exactly like what we did. We are going to jump to both our accounts receivable, general ledger account, and our allowance for uncollectible accounts. On the 15th, we're going to post the $1,548 as a debit, which then makes the balance for uncollectible accounts go down because that has a credit balance. And we're going to credit both account receivable for $1,548, which brings the account receivable general ledger balance down because the credit subtracts from the debit balance, $33,106.85. And we are going to post to the individual customer now, which is Horn Company, journal, page number G15, 1,548 credit balance makes the debit balance become zero. Looks like all is well, but it's not. We see the words written off and we see, ooh, we are not allowing that customer to buy anything from us on account again unless he or she pays us, and we're turning them over to a collection agency. So we're starting that process also. Now, thankfully, sometimes companies do pay us back, and that's what we're going to look at with starting in the month of December transactions. So if you read in your book with me, Working Together, December 8, received cash in full payment of Mellon Corp's account previously written off as uncollectible, $494. We have both a memo and a receipt source document. So that means we're going to post both the general ledger and account receivable customer account and the cash receipts journal. Okay, so let's start with the general journal here, December 8. Now, because they paid us, what we're going to do is we're going to debit account receivable, because by paying us, that means we're reopening it. Right now, that general account has a zero balance. So we're going to debit both accounts receivable and Mellon Corporation. Our source document is memo 158 for $494. And we are going to post from the 8th, we are going to post the $494 as a debit, which then increases our total account receivable balance because we're adding those dollars back in. And we are reopening up Mellon Corporation's account. We are redebiting. So we're going to write in the words reopen account. That's a good thing. So we're going to write in the $494 so that they have that balance again. And then we will be recording all of those source documents, or account numbers, excuse me, in this December 8th transaction. Now, while we're on this December 8th transaction, oh, for goodness sakes, it's going down very slowly for me. I'm trying to get my percentage back down. I'm pressing. Okay, I jumped ahead to the cash receipts journal. And so now you're going to journalize on the 8th the fact that you have received $494, you're going to credit account receivable, and you're going to debit